We've all seen the headlines. Some billionaire's net worth jumps by $10 billion in a single afternoon. Or your neighbor brags about being a millionaire because the housing market in your suburban cul-de-sac went nuclear. On paper, it looks like they're winning. But here's the shocking truth that no one tells you. Net worth is often a vanity metric. It's a scoreboard that doesn't always reflect the reality of your bank account. In fact, if you aren't careful, you could end up rich on paper while living on the razor's edge of financial disaster. Today, I'm going to explain why your net worth is lying to you, the danger of the non-liquid trap, and how to ensure your wealth actually translates to freedom. Because at the end of the day, you can't pay your bills with potential. You need cold, hard cash. Have you heard of the paper millionaire travesty? Well, let me explain it to you, but first we need to understand the basic math. As we've discussed before, your net worth is simply the difference between your assets and your liabilities. If you own a $500,000 house and you owe $300,000 on the mortgage, you have $200,000 in equity. Add in your cars and your 401k, and suddenly you're looking at a respectable number. But there is a massive problem: liquidity. Liquidity is the ability to turn an asset into cash quickly without losing value. Cash in your pocket is perfectly liquid. A house? Not so much. A 2021 Gallup study showed that while many Americans have a high net worth on paper, they are cash poor. Unfortunately, many folks are strapped to a lifestyle they can't actually afford. If you have $1 million in net worth, but $900,000 of it is tied up in the equity of your primary residence, you can't use that money to buy groceries, pay for a medical emergency, or seize a grand slam investment opportunity. You are essentially a prisoner in a very expensive house. It is one of the biggest travesties in personal finance. Being wealthy on a spreadsheet, but stressed at the checkout counter. To see how this plays out in the real world, let's look at two guys, Matt and Scott. Matt followed the traditional middle-class playbook. He believed that his home was his greatest asset. He poured every extra cent into his house. He did high-end renovations, paid extra on his mortgage every month, and bought expensive furniture to match the aesthetic. 10 years later, Matt's house is worth $800,000, and it's completely paid off. His net worth is $800,000. On paper, Matt is doing great. He feels like a king. Scott, however, understood the wealth formula. He bought a modest home but kept his mortgage because the interest rate was low. Instead of trapping his cash in his walls, he used his extra income to build a talent stack, learning sales and digital marketing to 10 times his salary. He then took that surplus and invested it into high-performing index funds and a small, automated side business. Scott's net worth is also $800,000. Then the economy hits a black swan event, a sudden market shift or a pandemic. Both Matt and Scott lose their primary income. Matt is in a desperate situation. He has an $800,000 asset, but he can't eat the drywall. To get cash, he has to try to sell the house in a down market, which could take 6 months and cost him 6% in commissions. Or he has to beg a bank for a home equity line of credit, HELOC, at a time when he has no job, making him a high-risk borrower. Despite his $800,000 net worth, Matt is living on the razor's edge. Scott simply clicks a button and sells a small portion of his index funds. He has the financial peace of mind to wait out the storm. He has sovereignty because his wealth is liquid. He isn't at the mercy of a bank or a real estate agent. He owns his time because he owns liquid assets. Scott and Matt's story is a simple illustration of how a mindset change and some education can make a huge difference. Now, let's look into the 3 specific assets that lie to you about how rich you actually are. These are the main culprits that keep people feeling wealthy while remaining functionally broke. Number 1, your primary residence. As I've said before, your home is a liability that masquerades as an asset. It costs you money every single month in taxes, insurance, and maintenance. Unless you're willing to sell it and move your family into a tent, that net worth isn't accessible to you. It's dead equity. It's nice to look at, but it doesn't buy your freedom. Number 2, retirement accounts, the age 59.5 cage. If all your wealth is in a 401k or an IRA, it's semi-illiquid. If you try to touch it early, the government takes a massive penalty cut. You are essentially storing your freedom in a cage that you don't have the key to yet. If a grand slam investment opportunity comes your way today, but your money is locked until you're 60, you can't seize it. You're watching the present pass you by while you wait for a future you might not even reach. Number 3, collectibles, jewelry, and cars. Whether it's a classic car, a diamond chain, or a fancy watch, these are often just marketing campaigns used to separate you from your money. They might show up on a net worth statement at appraised value, but finding a buyer willing to pay that price in a crisis is a nightmare. Try selling a luxury watch for full value when the economy is crashing. You'll be lucky to get 50 cents on the dollar. Now, does this mean you shouldn't own a home or invest in a 401k? Of course not. But you have to stop using them as a security blanket. To move into the upper class, you need to focus on utilization, the ability to actually use your wealth. You need to build a war chest of liquid assets. This is the money that gives you the ability to say no to a job you hate or yes to an opportunity that could set your family up for generations. Phase 1, the liquidity floor. Build a 12-month emergency fund in a high-yield savings account. This isn't an investment. It's an insurance policy against the razor's edge. It's the cash that keeps you from having to sell your house or raid your 401k when life gets messy. Phase 2, automated liquidity. Set up automated investments into broad market index funds like VOO or VTI. These are highly liquid. You can turn them into cash in 48 hours. This is your money machine. It's working while you sleep, but unlike a house, it's available whenever you need it. Phase 3, strategic leverage. Only once you have a solid floor of liquidity should you focus on locking wealth into illiquid assets. This is when you use good debt to buy real estate or invest in private businesses. You do this from a position of strength, not desperation. So stop obsessing over the big number on your net worth statement and start looking at your liquidity ratio. If the world ended tomorrow, how much of your wealth could you actually use to protect your family and maintain your lifestyle? The rich understand that money is a tool for sovereignty. If your money is trapped in assets you can't touch, you aren't actually free. You're just a well-documented servant to your balance sheet. You are trading your freedom for a feeling of safety that doesn't actually exist. Don't let your net worth lie to you. Stop living for a paper future and start building a liquid reality.